Okay. Hello there, traders. Welcome back to TOGS Trading Podcast number 41. Thanks for joining us for our session. Today, it's all about attacking a trend. Why would you do it? And how do you do it? So hopefully by the end of this session, you'll have a little bit of a better idea. Okay, all about attacking trends, all about, why would you choose to do it? And actually what are a few ideas that how you could actually basically go and do it. And I'll talk about one or two of kind of live examples that are ongoing at the moment. As always, I am joined for our chat, okay, by Big Ian in Dublin. How are you doing, Ian? Looking good, Billy Ray?
Slightly hungover, to be honest. I was out last night. I was over at a friend's house for dinner, and it was all the expensive wines and expensive whiskies, and floated home, sat on the couch, woke up 1 o'clock in the morning. That was my evening. Very exciting altogether.
So, expensive wines and whiskies, what were they like? In particular, the whiskies, what do you consider to be an expensive whiskey?
300, I think. Jameson 12-year-old something. It was old enough that the cork, when I pulled the cork out of the bottle, the cork disintegrated, but I think that's just a storage issue. I don't think that was necessarily the age. I think it was kept standing up and just dried out a little bit, which I've never seen in a whiskey bottle before, but yeah, it was quite nice. I'm not I drink whiskey all the time, but I don't have the same knowledge as wine would, as I would with wine. And then we'd Premier Cru, Puy Fissé, and so on. Quite a lot of wine drinking over the last. The summer is just the most bizarre.
Your entire life, you've done quite a lot of wine drinking.
Well, I went to wine school, so I actually know what I am doing. And one of the biggest hobbies I have is going to buying wine, is going to places. Like, I will not pass a wine shop without going, or even a supermarket, or even when I go to a petrol station, I even go and look at the wine section all the time, because you never know what's in it. And so I was in a small town in the west of Ireland, passing through some small supermarket, and I noticed the wines were all mispriced. And then I went back. I happened to be passing through the same town again when I had time this time, and stopped and went in and looked at the things, and they had €40 bottles of wine for $12.50.
Right, fair enough. That's a good trade.
And I went to the guy on the counter and said, "These are supposed to be," and he was, only working.
Yeah. So did you buy them all up then? That's your trader. That's your trader looking for value, but in a random centre in West Island rather than the cash session of the S&P. But there you go. Listen, everybody loves a good trade, don't they? Everybody loves a good trade.
And I did actually buy and sell like proper wine back in the old days, because there is an exchange for it, and through Corny and Barrow I had.
Corny and Barrow. That's the name.
Yeah. And I made £20,000 or something doing it back in the day. I wish I still had them. I owned, for people who are into wine, I had a case of Lafite Rothschild 2000. I paid £1,760 for it.
Jesus.
Yeah, I had two 1999 Domaine de Romney Conti, the actual DRC wine, and I paid £600 for it, which is nothing. You're talking thousands of pounds now for the same things. But anyway, that's what it is.
I'm not entirely sure. I'm not sure I'd entirely consider spending 300 on Jameson's a good night. But there you go. Each their own. But anyway, more importantly, let's talk about trading, and in particular. Let's talking about trends, all right? Attacking the trends. Why would you want to do it, and how would you go about it? So, what's your view, Ian? Where are you coming from on this?
With trends, well, the first thing is, what's a trend? So trends are not the same for everybody, I think.
True.
Because in general, for what it is for me, is a trend is only basically when price breaks. We say an uptrend, because it's easier to talk about uptrends than downtrends. When price breaks resistance and then holds a pullback, and that's your first stair step on the stair steps. Yep. And that's basically what trends look like. For me, I am a range trader, so I break the market up into ranges that look a little bit like Darvis boxes in some ways, but they're not. And And so the range for me, which can be anything from 20 to 100 ES points, the bottom of that to the top of that takes about sometimes takes 3, 4, 5 days to go all the way from one side to the other. And that is the trend. So my basic, not that I'm a swing trader, but my basic swing tradery setup is from the bottom of a range to the top of a range. Sorry, from the bottom of the range to the middle of the range, because the middle of the range has a decision in it too, and then up to the top of the range. And that's my basic thing. So that looks like a trend to everybody else, but it's basically just crossing a range for me. So that's what they do for that's what they do for me. And then you have intraday trends, which are my bread and butter. Excuse me. And they're basically again, they're actually basically small ranges. They're price moving from the bottom of a range to the top of a range, or else it's a news thing sometimes, that starts off a trend. There's all sorts of this. And how do you enter them is relatively straightforward. It's sometimes particularly because you don't have that much time in intraday trading, it's you just hold your nose and press the button and get in. Like one of my favorite things is if I see 2 or 3 green bars, like strong green bars, bullish bars, is I'll just buy the first small pullback as long as the pullback isn't too deep. I mean, it's that easy basically. So it's not particularly difficult. And a lot of the time, like entries in trends are not that important.
Yeah.
Because the only thing that really matters in a trend is that you pick the direction and you enter with the appropriate stop, so that you don't get stopped out in the normal to and fro of price movement. And then you sit in your hands, which is possibly one of the hardest things you can ever do with trading, and probably one of my greatest weaknesses in trading is I'll tend to have a look at the trade that I'm in. I mean, I'm in a trade at the moment. Actually, I entered on a double bottom this morning.
Okay.
And I have no idea how it's going. Actually, I've stopped put in, and I had ads input. Actually, instead of I started off with a single contract, and then I have ads for the next 20 ticks down, which is not usually how I work at all. But we'll see how it goes. Anyway, it has a technical target, and I'm quite. There's nothing I could see between where I entered and where the technical target was. So I'm not that particularly worried about it. I'd be interested to see how it goes actually, but
well, we can have a look at that later, Coleman. I'll be watching that and stuff. That's like an interesting aside there. Sorry to go back a little bit. You mentioned Darvis, Nicholas Darvis and stuff. His book, How I Made $2 Million in the Stock Market. It changed me from being a pure intraday trader to being a long-term trader. I had a bad sports injury about 15 years ago, and I was laid up for a couple of weeks. And I read the book then, and it kind of changed me from being from a pure intraday trader to a longer term trader. I also met a guy weirdly I was living in Oxford. I met a guy who had met Darvis. The guy wasn't a trader. He met him at like a business function, and he went and had dinner with Nicholas Darvis and said he was the most miserable sod ever. He said he was like literally the most miserable guy, and he spent the whole evening complaining that he hadn't made enough money from trading, that he wished he'd made more money from trading. And this is a guy who made $2 million in the kind of the late 40s, early 50s. That's a good sum and stuff. He said he was the most miserable sod ever, which doesn't come across in the book or anything else I've read, but there you go, as they say, you should never meet your heroes. That's enough. So,
but that's what I found with meeting or talking to like some great traders over the years is that when you're talking to them, a lot of them are kind of guys who go home and play with their train sets. Like, there's nothing. There's nothing just personally special about them. They're not. It's how they think tends to be because they're not doing anything. There's no big secret sauce thing that they're doing. An awful lot of the best trader I've ever had to do any real work with was doing nothing special. It was a few trend lines, but he'd hold his nerve and he they were consistent in how they were thinking, and that's an awful lot. That's the thing that you rarely come across, is sort of true consistency in traders.
Yeah.
So I think it's just a different way of thinking. I think that's all it is with them. So it is.
It is. So, I would just to kind of add to your little comments there and stuff. So I should declare who I am as a trader in terms of on an intraday basis. I am very much a mean reversion and reversal trader, because I think 80% of the time intraday markets, especially FX markets, are range bound. You get one good trend day a week maybe, but the rest of the time it's primarily mostly kind of range bound, which suits mean reversion and reversal. So, as an intraday trader, Paul is very much a mean reversion reversal trader. But swing trader, Paul, position trader, Paul, is very much about where possible. My strategy is desperately simple. Okay, I am within FX indices and commodities markets. I'm looking to buy strength, sell weakness, and ideally enter on a pullback using a price action as a trigger. There you go. That's it. Bang. Very, very simple. All right. So it's a case of, if a good trend leaps off the chart, I mean, you can use whatever indicators you want if you feel the need for it. But reality is, a good trend, leaps off the chart. The challenge we have is that markets tend to only trend 20 to 30% of the time. But when a good trend leaps off the chart, well, then you don't want to fight it, right? Don't fight it. You basically want to find a way to surf it. And in good trends, pretty much anything works. You want to trade a breakout, that's fine. You want to trade a pullback, if you get a pullback, that's fine. You want to trade bounces of moving average, you want to trade breakouts of Kelton charts, etc., etc., etc. In a good trend, pretty much everything works. Everybody's a superstar, everybody's a rock star in a good trend. But as I said, markets only tend to trend 20 to 30% of the time. I know I work on a premise for my own trading, is that as a sort of swing trade in FX markets, is that I will get, on January 1st of every year, I will get 3 to 6 good, what I would call super trends. I'll get 3 to 6 of them a year. The thing is, I don't know when they'll come, and I don't know where they'll come. I might have an idea, I might have a sense, but anybody who's telling you they know exactly where the trends are coming for the year ahead is probably talking out of their hoop. But that is why every 2 hours every Saturday I'm doing my weekly analysis without fail, because basically the whole idea is to give me an understanding of where's the strength, where's the weakness, and is that then followed through with a trend and followed through with the momentum. So a very, very good example of that at the moment, all right, over the last 6 weeks has been a case of trading, basically shorting the yen. So for the first half of this year, you could basically short the dollar and buy pretty much anything else, in particular things like Swiss franc and sterling. But if we look now over the last, people can look at this, on their own charts, over about the last 6 weeks or so, it has been about shorting yen, in particular, basically buying Swiss yen, buying euro yen, and this month a little bit of CAD yen, because basically Swiss franc and euro, they are strong by my Stan model. Japanese yen is bottom of the pile, so I want to be buying strength, I want to be selling weakness, and when it's in a good super trend like that, well, then I have the conditions to basically attack the trend. Does that make sense to you?
Yeah, no, absolutely. I was just sitting down there making a little note about intraday trends. Intraday trends tend to start early enough. They tend to be there within the first 10 to, because I won't talk about time because we're all in different time zones. So I'll talk about just do it in bars. So, but the first 10 to 15, first 10 to 18, which is 4 o'clock, 18 bars. You generally have the higher the low in at that stage. By 4 o'clock in Irish time, you generally have the higher the low in. So yeah, that's quite, and then a lot of the time, the very first move in the day is in the wrong direction to the what the actual trend is going to end up. So you get a little V bottom, basically, sometimes a lot within the first within the
I think
first 10 seconds bars.
just to interrupt you, it might be a bad idea for people who are sort of kind of listening and watching this. When you're talking about an intraday trend, it probably would help people to just confirm what market you are particularly talking about. Just to help people make sense of the comments and stuff. So I know what you're talking about, but it probably isn't a bad idea if you just confirm what market you're talking about.
It's the S&P 500, so the ES, the E-minis, or MES if you prefer to trade them, because they're all pretty basically the same. So what ends up happening a lot of the time in, like, my first trade of the days generally is something like gap trade. So the if you're in an uptrend, what happens a lot of the time is you're in a daily, you're in an uptrend, and the daily chart, you're basically, as an intraday trader, you're trading the needs of the daily chart on a lower time frame. So you would have the open, you would have price with gap up, and generally the first move is a retracement to about 50% of the opening gap.
Yep.
And that's especially strong Tuesday, Wednesday, Thursday. Has the highest probability. And if the 21 period moving average is in the gap area, it has a higher probability. So it's because price will move to the 21 period moving average anyway. So they can look at yesterday's open for it. It was perfect. What you find as well in uptrends, when you have a daily uptrend, what you find is that very simple setups and patterns work the way you expect them to. So if you're looking at a double bottom, a 5-minute double bottom or a 60-minute double bottom in the ES in an uptrend, that is a high probability of working. So if you're on a daily chart and you expect your analysis says that you're in an uptrend, and the way that I would know that is I would have a large range, and I'd expect over multi-days for the range, for price to go from one part of the range to the other part of the range, from the bottom of the range to the top of the range. So what I find is that during the day, then I don't want to be shorting. I only want to be taking things like double bottoms. If I get a bear channel, I want to take the breakout to the upside of bear channels, that kind of stuff. There's a few other little things that you will know, that you have a trend day and the next day tends to be quiet.
Yeah.
In my own experience, and not every single day, but usually if you have a big trend day up, the next day is going to be quiet, because what happens is everybody's a little bit stunned and they all sit there and they want to see that there's no reversal. They want to see, because if there was going to be a reversal, it's going to be the next day. So you have a good idea that you're going to get a kind of a rangy day after a trend day quite often. Yeah, so that's a big thing, and that's what I can think of off the top of my head about
just well, as you mentioned that in itself can be a sort of swing trading setup, as in you've had a let's call it an outsized day. All right, an outsized day. So you've had a day where the intraday action is, is just put in a great trend, and it has created a large outsized bar. Okay, maybe it's a outsized bar. You're absolutely right. The next day, not always, but can be. I talk about this. Markets are like humans. We surge, we rest, we surge. So we've had a day where there's been a surge. The next day can be a rest day. So that might create, ideally, something like a small inside bar on the daily chart. And then, as you say, the day after that, then basically that trend can extend. Or if it's going to, that sort of on that kind of almost like the third day, the trend re-exerts itself and goes. And that can be a great opportunity for either as a swing trade, or if you're like yourself, an intraday trader, to position yourself accordingly to be ready for that to occur and stuff. So it's almost like you get large bar, small inside bar, large bar. It's almost kind of like a some might say it's like an ABCD pattern, in micro, but without us being able to draw these here on whiteboards, etc., which maybe we'll get to in the future. I don't want to get too complex, but yeah, people can see that in the chart. Go away and study.
One of the great things, pullbacks once you've had uptrends, pullbacks tend to be always held, because the problem is that if they break a pullback, right? So if you go back to we say to a 50% fib, 50 to 618, that zone. So that's a little box. We call that like a little Darvis box as well. That is generally going to be held because people are looking about who's in control. So if they cannot support price in a particular area, then they're not in control. They're not trying to. It doesn't make them as much money as you would think when they start screwing with people's stops. So what as it does as if they control the whole trend. So they want to control the whole trend. So these pullbacks tend to be always all tend to be held. And one of the other great things, like one of my favorite setups, which you don't see that we do see occasionally, is when you're in an uptrend on a daily uptrend and you have the first low of the day put in before 4 o'clock or the 18 on the 5 minute, and then you have another one that comes down, another low comes down to test it, creating a double bottom. That has really high probability of working because the low is generally 90% of the time the low is in by 4 o'clock or the high is in by 4 o'clock. So they have to support it. So that setup then ends up having this hugely wonderful probability of basically 90%. So it's quite a good thing to see. And then you're using, if I trade a double bottom, what I do is I draw a fib from the high of the leg to the turn, and then I want to see it at least touch the 38.2. And if it doesn't touch that, if it goes through that, then I want to see it do the full 50. And if it goes up over the 50 and then over the 618, then the pullback is a buy as well. So it's if you've exited by that stage, if it goes through that, then you're into possibly a new trend, and the buy is a pullback. Or sorry, the pullback is a buy, which is quite a thing.
Yeah.
Trading is really mechanical, in those kinds of ways. You're just looking for the same thing. Get up, start your afternoon, do your gap trade. Later in the day, after 4 o'clock, you have your high and your low in. So you're either doing a double top or a double bottom, probably, or else you're doing a breakout of that. Then if it comes to the bottom of the range or the middle of the range, then you have that range, those decisions. That's your day.
Yeah.
There isn't really a huge amount else that you can be doing, like,
Yeah. No, I'd agree with you there and stuff. It is a case of as I said, I am primarily on my intraday basis, that is trading FX in the morning. I'm a mean reverse trade, but that's not to say there aren't trends. Okay, that's not to say there aren't trends. And then it becomes a question about, as you kind of said there, is that people like to trade pullbacks, right? People will trade breakouts or pullbacks. As I said, in a good trend, breakouts will work. I tend to prefer to trade pullbacks, but I also have to be aware. You always have to take on board that sometimes a trend is just so strong that the kind of pullback, you have to trade the pullback you're given, not the pullback you want. Okay, ideally we love a nice technical pullback too, a 20-period moving average or back into a fib element, but sometimes the trend is strong and the pullback is very shallow, and that in itself is telling you that there is real strength in that market. It's telling you that basically it's invariably it's off. And once again, you have to trade the market you see. You have to trade what you see, not what you want, because what you want and what you get can be very, very different. And and admittedly, there is part of an element of experience in that, and having seen your way through a few trends. You made that interesting point out on that kind of intraday US index market there about how market will come back to touch what I think is a 21-period moving average. I will use a 20-period moving average on longer term swings. If you look at look at Swiss yen, look at euro yen on the 4-hour charts at the moment. Okay, they've been fantastic on the daily. The trends, they're also 4 hours pulling back to moving averages to and bouncing off there. That's what you want. The challenge, as I said, is you don't always get what you want. All right, you need to know what you're looking for. All right, you need to know what you're looking for, but you also have to be able and be prepared to adapt to what the market is playing out in front of you. I think then it also becomes about focusing on the word attack. And now maybe this is just me. Maybe this is just me and my background. Okay, what I'm talking about that is, very often people will, they'll take a position or let's say take a trade, right? Let that and try and ride that trade, as you said earlier. But when I'm talking about attacking a trend, I am talking about turning a trade into a number of positions. Okay, I'm talking about when you get that super trend, which for me, as a swing trader, the super trend is when price is very gladly above its moving averages on the 4 hour, the daily, and the weekly. It is that train has left the station. All right, okay, it's off, and if you're not on board, you need to find a way to get on board at a station as it goes on its way, and that then becomes about attacking a trend. And I think the way as a swing trader, you make a step change in your equity curve is by attacking those trends when they occur. But as I said right at the start, you might only get 3 to 6 of them a year as a swing trader, and it's about knowing when knowing and understanding what you need to see to confirm yourself that you have got super trend, so that you are in a position to attack it, because it's what you need to do. If you're going to be a trend trader, you need to be prepared to attack the trend.
Just because you referenced a Rolling Stones song, I met Ronnie Wood once, and I didn't know who he was. I did. I was working in a wine shop, and there was a delivery, so it was only around the corner. So I just threw it on a pallet truck and ran around the corner to an art gallery, and I was standing in the hall waiting for somebody to go in and accept my invoice or whatever it was. And I was talking to this old fella in the hall with mad dyed hair, and we were chatting away. It was basically weather, isn't it lovely? And I went home, switched on the television, it was Ronnie Wood. He's an artist, and he was putting on an exhibition.
Listen, to be fair to him, he probably went home to his lovely wife and said, "I spent the day with Ian McFadden."
Yeah,
trader. He tried to get me to trade the gap. He tried to tell me to trade the gap.
Yeah. But one of the great things about being entering trends with being a range trader is that you have a really good idea where price is going to, because if price doesn't actually touch the other side, touch the bottom or touch the other side, there's only two things that happen. So if you don't get a touch, because this happened this morning actually when I started off, is that I had to slightly redraw my charts within my own rules to accommodate the move, because the move was front running the area I had in currently, but under my rules I was able to adjust that. That's no problem. So once it's touched that side and held that side, the bottom of the range, I have a good idea it's going to go to the middle of the range or to the top of the range. So if I enter at any time in that, I have a good. It allows me to hold sometimes when holding doesn't seem necessarily the smartest thing, or add when adding doesn't seem like necessarily the smartest thing that you could possibly do, because you have a good idea that price is going to go to the other side. Because what generally happens if it does not go to the other side of the range, if it genuinely front runs the top of the range, and you can't adjust the range for it, that's bearish. That's really bearish. So it's, you're going to get stopped anyway. So it doesn't make much of a difference. So it's and that's the big thing. You have a good idea where your range, where your trend is going to start, and you have a good idea where your range is going to, where price is going to go to test. And you can do that on daily, you can do that on a monthly, you can do that on any time frame, basically, because what I think happens, and it's what I've seen with oil. I used to trade oil all the time, CL, and you'd have price because that's even more rangy. Like CL is more rangy than yeah, and it's also, even when you're trading it, when you're buying the contracts, there's loads of slippage and everything. It's a different animal. And then because you have that, because it's thinner, they have to move it further to ensure that they're getting in and out. It's not like the ES where there's billions in it every day. Like, so what would happen with CL is that it would, I've forgotten what I was going to say now. That's the problem with doing these things when you've been out the night before.
There you go.
Well, which is terribly unprofessional of me altogether. Forget the great point I had to make about.
You need to have a word with yourself. Going out, enjoying yourself, gallivanting, drinking wine and whiskey on a school night. I'm telling you, it's a shocker. It's a shocker.
Terrible. I'll slap myself on the wrist, myself in the face later on. All there, it's just terrible. But it's but anyway, oil use. Oh yeah, sorry. So what used to happen basically with oil is that it would start at the bottom of the range and it would move up to the top of the range. And if there was something, I remember there was some sort of a refinery fire or something, there was some, anyway, biggish news event. And I
Yep.
remember on all those sort of message boards and stuff like that at the time, it was a few years ago. Oh, oil is going to pull back now because of this news. Yeah, it did for 2 days. And then resumed the thing. And what it did basically is that they let it, people were going in, all these sort of amateur people were going into short it in the wrong place. They absorbed all of the sales and then just blew it out of the water. And then by blowing out the shorts out of the water, they actually increased the fuel for the upcoming trend that was going up. So what they do is that they buy their position low. They spend a good deal of money and they build their big position, and that's what basing is basically position building. Well, that's what you see in the charts. And then they move out of that area, and then they keep some of their money to protect price movement on the way up. And that basically means that even that they have a technical target, they know where they want to make money. And it doesn't matter about the news to a certain extent. There's only been a few times I've really seen news just turn the market. Like Brexit was one, for instance. 9/11 was another one, for instance. There's very few times that the whole, like, there has to be a seismic shift in something. And it basically, what I learned from trading oil is that it takes fundamentals 3 to 6 months to really get into affect price. Fundamentals do affect price, but the thing is that they have bought at the bottom of the range, their profits at the top of the range, and damn the news if it's going to interfere with it. The news is only there to help them. So the good news pushes price further, brings in new entrants into the thing, so they get to their profit target faster. Or the news pushes price back, which means that they can absorb the amateur money or the smaller money coming into the market, the not professional money coming to the market, and then just blow them out of it and cause them to go and buy to cover their shorts. Or people who sold their positions, they're just absorbing up the positions that were sold and adding to their underlying position and making even more money. So, that's why trends in their own way are important. One other point that just occurred to me there is that really strong trends, particularly in stupid stocks that that shouldn't be doing so much, can be really weak. It's one of the reasons why we trade at Bitcoin, because they have really strong trends that are really weak. Anything can turn them. A stiff breeze can turn them. It's
very true.
I don't want to be dealing with that. I'm a technical trader. My edge is in the fact that I do the same crap every day. It's not in I can't outthink the market, and I think an awful lot of these people who go into Bitcoin or FDA approved drug things are actually basically trying to outthink the market.
And I think they think they've got some sort of black edge, and most of them don't and stuff. But that does actually make a good point, because TOGS Trading Podcast is going to be back in 2 weeks' time, and TOGS 42 will be all about what is your edge as a trader. So we can talk about black edge amongst other things there. So I suppose because once again we could talk about this for ages, but we need to draw it to a close. We want to try and sort of be kind of 25 to 35 minutes in our conversation. So we can start to draw to a close in the sense of trends are great. Right? Everybody loves a great trend, okay, but good trends leap off the chart, but they don't occur anywhere near as often as you'd like them to be. Only 20 to 30% of the time. But when a good trend is in place, you don't want to fight it, do you? You want to surf it, all right? You want to find a way to surf it, whether that is on an intraday basis, whether that's a swing basis, whether that's a position basis. They don't occur as often as you like, but when they are, then basically you want to be able to take to get into that. And then for me, my view, as I said, for a swing trader and above, most definitely the kind of way you change your equity curve is to basically turn your trade into a position by adding to that trade and trying to, as I say, surf the biggest waves. That's what you want to do. And if you want good examples of it at the moment, as I said, just look at Japanese yen on the daily chart, and in particular Swiss yen, euro yen, basically even CAD yen this month, pound yen, okay, in the previous months, etc. Just looking at really buying strength, selling weakness, and that Japanese yen weakness has created a lovely trend, and that's what you're looking for. Cool. Any final points, Ian? Any?
What you don't want to be doing is sitting on the sidelines watching, which is really the saddest thing in the world, is sitting on the sidelines watching a trend going up that you were, for some reason, didn't enter, and just watching it go to target and then sitting there like a big idiot going, oh, for God's sake.
Yeah. The thing is, we've all done it as traders.
Loads of times.
It's only,
I think it was one of the great signs of experience where I started just basically going, press the button and
get in the trend, surf it.
What are you going to lose? You're going to get stopped. Big deal. You get stopped
exactly
2 times a day, 5 times a day anyway. So
totally brilliant. All right, well, listen, let's draw it to a close there. Thanks very much for everybody joining us and listening. And once again, thanks very much for those of you who've sent us recommendations. Okay, what you'd like to see as covers, we're putting that together. We have taken it all on board and we'll put it in. As I said, it's going to be 2 weeks before we're back in TOGS 42, and we'll talk about what is your edge as a trader. And in the meantime, if you have comments or if you've got any thoughts about what your edge is as a trader, we'd be delighted to hear. So until that time, everybody, listen, have a fabulous couple of weeks. As always, okay, wish you the best of success in your own trading endeavors, and we'll speak to you soon. Trade well, everybody. Cheers.
Bye.